Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what we've got in store for today's show. First up, we're going to be talking about consumer credit card debt. It's hitting some record highs, so we want to talk about why that's important, maybe why it's a good sign for the economy, maybe why it's a concerning sign for the economy, and some of the figures, so we'll drill into that. Then in our second segment, we're going to be talking about a different kind of hopefully healthier debt, and that is mortgage debt with our mortgage pro, Steve Tetzner from Homestar Mortgage. We're going to be talking about the trends that we see coming in 2018 on a variety of issues, everything from interest rates to taxes and everything in between. So we've got that to look forward to in our second segment. In the third segment, we're going to try to answer a question that I get all the time, and that is, how long do I need to hang on to this thing? And that thing is often some statement, some receipt, some kind of investment statement or other banking record. And people always want to know, how long do I need to hold on to this stuff? So we're going to try to answer that question, give you some guidelines, keeping in mind that there's no real right or wrong answers to this stuff. So we'll try to give you some pointers on how to figure that out. And then finally, in the last segment, we've got a viewer question on the advisability of buying stock in the company that you work for. So we're going to cover that in the fourth segment. So that's everything we've got to get to on today's episode of the Money Pros. So let's jump right into it. The first thing we want to talk about is credit card debt. There's a new survey out from a company website that we talk about quite a bit because they do some interesting research called Wallet Hub. And this is their 2018 credit card study where they look at trends in credit card debt for consumers. And this is important for a couple of reasons. And it's important to keep in mind that the level of credit card debt really kind of cuts both ways. It can be an indicator in two different directions. It can actually be a positive thing because one of the things that we've seen in the economy over the past several years actually is improving consumer sentiment, consumers feeling like the economy is doing better. Now I know there's somebody sitting on their couch thinking the economy's not doing better, I'm miserable. Not talking to you, I'm talking to everybody else that thinks that things are actually getting better. And if you look at the consumer sentiment surveys, it definitely suggests that consumer sentiment is improving. And one of the ways that we see that is people being willing to charge more on their credit cards because they have higher confidence that they're going to be able to pay those bills back. So in one sense, it could be an encouraging sign. On the other hand, it can be concerning because the more money that people are borrowing, it could indicate that they're doing that in order to just make ends meet because they're not making enough money. And certainly it would suggest that perhaps they're not actually saving enough because they're servicing credit card debt. So there's a lot of issues to be unwrapped there. But as we look at the Wallet Hub study, they looked at a variety of different information sources, credit rating agencies, the Federal Reserve, and the FDIC. And here's the slide. And the first thing up is total debt. So at the end of 2017, total credit card debt in the United States outstanding was $950.2 billion. That is a significant amount of money, and it's actually up 6% from the figure where it closed in 2016. So a marked increase in the total credit card debt. Next up, the average amount per household, and according to their study, the average household credit card debt is $8,131. So I would encourage you to use this potentially as a benchmark. Do you have more debt than this? Do you have less debt than that $8,000 number? It doesn't necessarily mean in either direction if you're financially healthy or not, but it's one indicator to see how you stack up versus the average American when it comes to credit card debt. And I would also point out that that average figure is also up 6% over the 2016 number. And finally, the 2017 net increase, the total credit card debt that was added on by consumers in 2017 was $92.2 billion. So we're talking about a significant amount of money. So some other interesting things that came out of the Wallet Hub study that I thought I'd point out. Total credit card debt, that $950.2 billion, is at the highest point it has ever been. So we have more debt, consumer debt on credit cards than ever. The average household debt of $8,131 is at the level just prior to the Great Recession in 2008. So we've seen average household debt rise to the level back before the financial crisis that is fresh in many of our minds. In 2017, the quarter four accumulation, so the amount of debt that was added on in the fourth quarter of 2017 alone, was $67.6 billion in the fourth quarter of 2017 alone. And that figure is the highest it's been in 30 years. So another major milestone when it comes to credit card debt. And here's the final thought that I want to leave you with. How are consumers doing at paying back this debt? So far, they're doing pretty well, because charge-offs by banks, when banks write off the amount and say, you know what, we're never going to get paid back, we're just going to take this as a loss, charge-offs are at all-time lows. So right now, consumers are able to service their credit card debt. But the fact that that's happening is also encouraging banks to lend to people with poorer and poorer credit. So it's a trend that we definitely need to keep an eye on. All right, so that's a little information on credit card debt. Up next, we're going to be talking about a different, healthier kind of debt. That's mortgage debt with our mortgage pro, Steve Tetzner from Homestar Mortgage. Stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined now by our mortgage money pro, Steve Tetzner with Homestar Mortgage. Steve, thanks for being back with us.
Pleasure.
So we were talking before the break, which seems eons ago at this point, I don't know why, about a variety of different issues going on with the economy. And it's interesting how things are so interrelated. I mean, we're talking about the stock market, bond markets, interest rates, and of course that ties back into mortgages. So I think 2018 is going to be an interesting year. So we want to kind of cover some of the, you know, it's kind of a cliche term, but the like themes that we might be seeing in 2018. Hopefully so our consumers can be better educated as they move forward if it involves a mortgage. So the most obvious thing to talk about is interest rates. Now, we're sort of beating a dead horse here because we talk about interest rates all the time, but it really can't be avoided, and I don't think we'd be doing our viewers a service if we didn't revisit it. What do you think, what's going on, what's happened with interest rates so far in 2018, and what is your outlook going forward?
Great question. So, so far since the beginning of the year, approximately January 10th, we've seen a gradual increase in interest rates, and we've seen approximately a 0.5% increase in the 15, 20, and 30-year mortgage rates. The projections are that going into the end of the 2018 year, we're going to see approximately about another 0.5% increase in mortgage rates. So, you know, from November, December of 2017 to November 2018, overall, we could be talking as much as a full 1% increase in 1 year.
And that's a significant amount, and we'll talk about how that affects consumers, home affordability, and things like that. But one of the things we've talked about on the show that I think is worth revisiting, because it's reflected in the stock market and a lot of other things we talk about on the show, is why mortgage rates go up. I mean, we talk about the Fed raising rates, and that contributes to a rising rate environment, but the Fed does not set mortgage rates. What controls mortgage rates?
The markets. You know, for the same reasons that the Fed is raising rates, that's what causes mortgage rates to rise. So things that are positive in the economy, low unemployment, low jobless claims, CPI, growth in the economy. And when you have a good economy, mortgage rates go up. And it's the same thing with the Fed. So the trend is really the same, and it's the same factors that drive the two. But you're correct. Most people think that, oh, the Fed raised rates a 1/4 point, mortgage rates went up a 1/4%. That's not true. That's not the way it works.
So important as we continue this conversation to realize it's not the government setting the mortgage rates, that it's the market. And rising rates, and I tell this to clients all the time, they can be discouraging if you want to borrow money, but it's oftentimes a sign of a healthy and improving economy. It's good that rates are going up to some extent. But it's not great for people that want to borrow money, particularly when it comes to borrowing money to buy a house, because it's such a significant loan. And the issue of affordability, I think, is, of housing affordability, is a nationwide thing, but I feel like it's particularly acute here in Rhode Island, where we have a trend of real estate market's been great, housing prices are going up, inventory is particularly low right now. There's not a lot of houses to choose from. That's already making it challenging for buyers. when you factor in rising rates, what does that do to the housing affordability equation for the people that you're talking to here in Rhode Island?
So for the average consumer, really, it's not having an effect on the market. Right now, what's really driving the market and the prices is the lack of inventory. We are very heavily swung towards being a seller's market. Where we're seeing the affordability issue is more on the first-time home buyer side. So people who are typically buying the houses under $225,000. When you talk about a 1% increase in rates, so take someone buying a $175,000 home, with a typical first-time home buyer mortgage, you're talking about a $100 a month increase in that mortgage payment. What it really impacts is the person who maybe only qualifies for a $1,350 a month mortgage payment. Well, when rates are low, they could buy a house for, say, $180 or $185. Now, all of a sudden, rates go up. They still can only afford $1,350 a month. Now they have to find a house for $165, $170. So a 1% swing is going to have, a good $15,000, possibly $20,000 impact on the affordability and what that person can buy. Now they have two factors working against them. You have rising house prices, rising interest rates. Now that person who, is at the lower end of the spectrum may be completely priced out of the housing market altogether.
So, and that's what I find fascinating. It's not just a sort of theoretical economic model of rates go up and people have to adjust their expectations. You're seeing that with the consumers, at least at the lower end of the market, the less expensive homes. They're altering the decisions about how much house they can afford.
Absolutely, and it's not just what they feel they can afford, it's what the bank is willing to qualify them for.
Right.
So, it's not like the Wild West days of 10, 15 years ago where anybody could get a mortgage. People have to actually qualify. They've got to be able to demonstrate the income and the credit standards to be able to get the loan. And we look at debt to income ratios.
Right.
So it definitely has an impact, more so really on that first-time home buyer market.
And I've got to believe that that's discouraging for first-time home buyers, where inevitably you always want to buy a little bit more expensive house than you can actually afford. There's not a lot of options out there because inventory is so low. And then simultaneously, you're getting the news that interest rates are climbing up, which is even making the houses you thought you could afford all of a sudden not affordable. So it's got to be discouraging. But you talked about something else which I want to ask about, and we've talked about on the show before, and that is the need to have to qualify for a mortgage. It's not the bad old days of, make your mark here and we'll give you the check.
The mirror test.
Exactly. Can you fog it? Sure, exactly. But is it becoming easier or harder for people with less than great credit to get a mortgage?
It's becoming easier. We're starting to see new products that are becoming available in the market. There are new bond programs that are expanding where, for example, we just rolled out a program last month where we'll now lend to somebody down to a 500 FICO score.
Okay.
Now, these credit standards, they call them non-QM products. So QM was the qualified residential mortgage. That's what the Fed standards through Dodd-Frank, where they want to make sure that the mortgages were being given to people that had the ability to repay them properly.
And these loans are a little different than the traditional first-time buyer type stuff.
Correct. So they're not. They're back to the days of probably 25 years ago when the original non or subprime product came about, where it was meant to be a Band-Aid loan. So it allowed for somebody to borrow money who had less than perfect credit. But they're at higher interest rates. Back then they were typically short-term adjustable rates. What we're seeing with the product being developed now is it's more of a safer product. There's some fixed rate product, but we're seeing more longer-term delayed ARMs, which means that the rate they start with, instead of only being fixed for a year or 2 years, is 7 years or maybe 10 years. So it's a little safer. They're still qualifying for the payment, but the most important thing is it's requiring a much larger down payment. So your typical first-time home buyer with good credit who can maybe buy a home with a no money down or a 3 or 5% down, this particular borrower is going to be required to put a minimum of a 15, 20, or 25% down payment.
So we're not going to see situations where a less than highly qualified borrower is sort of immediately in a negative equity situation because they're being required to put money up front for these loans.
They've got skin in the game.
Right.
So
they're not going to be tempted to walk away from the property or something like that.
Absolutely.
But the thing I always get nervous about, like, they have to have income, right? They have to be able to show to the lender, for the most part, that they've got money coming in the door. Maybe their credit record wasn't as great as it could have been, but they have a job.
Well, they have a job or they have income. There are some new products that are starting to come about that are the old 12-month and 24-month bank statement programs, where instead of looking at someone's net income from their private business, they're looking at the revenue and the cash flow of the business to qualify for the loan. So there are some more creative products that are coming out, not anywhere near as aggressive as what we saw back when the crash happened.
So we've got less than a minute left, but another thing that I wanted to ask you about is what impact you see the changes in tax law. We've just seen one of the biggest changes to tax law in the past 30 years. Mortgages were touched to some extent. Do you see that having an impact on the markets going forward in 2018?
Not in the short term. I mean, maybe long term people might make different decisions, but the changes were more on the high end of the market. So I don't think that we're really going to see much of an impact here in Rhode Island.
Even though, like, do you find people talking about the tax advantages of owning a home, whether it be the deductibility of property taxes or the mortgages? Or is that on people's radar screens?
Absolutely, and more so in the first-time home buyer market. But you know, the deduction on the mortgage interest only went from $1 million down to $750,000.
Right. So those people aren't likely to be affected by that.
Right.
And the houses they're buying probably aren't so expensive that they're going to go over the $10,000 state tax deduction limit as well.
I mean, for the real estate tax.
Right.
Yeah. Well, I mean, it depends on the market. I mean, if you buy a home in certain markets in Rhode Island that are, you know, $500,000, $600,000, $800,000, $1 million, you could be paying $12,000, $15,000, $20,000 a year in real estate taxes.
But to your point, it's going to impact people at the higher end of the market.
Yep. So I don't think it's going to affect the general real estate market.
All right. So I got about 5 other questions I could ask you, but we're out of time. So thank you very much once again.
Great to be here. Thanks.
All right, folks. Up next, we're going to be talking about how long you should keep particular financial records. So stay with us. There's more to come here on the Money Pros. Hello, everyone. Welcome back to the Money Pros. I want to talk about a question that I get all the time. I imagine a lot of accountants, financial advisors get this question as well. And that is, people want to know, how long do I need to hang on to all this paper? The financial industry is notorious for generating a lot of paper, statements, confirmations, receipts, records of all sorts. And of course, then you have tax returns and other documents that go along with filing your taxes. So we have a lot of financial records, and people are often confused by exactly how long they need to hang on to this stuff. I know some people that are total pack rats. They have receipts for credit card bill for dinner out, 15 years ago, filed away in an envelope somewhere. I also know people that couldn't lay their hands on a financial document if their life depended on it, and they depend on being able to get copies of it from various institutions should they ever be required to track it down. So let's talk about some of those things and give you at least some guidelines on how long maybe to consider hanging on to it, keeping in mind that everybody's situation is specific, and you may have specific issues which require that you hold on to your paperwork longer than maybe somebody else. So you've really got to take that into consideration. Having said that, first let's talk about things that you should probably only need to keep for a year or less, and maybe only as long as a month or so. So the year or less category would really be things like ATM receipts when you deposit money or pull money out, bank deposit slips, credit card receipts, things like that. You really don't need to hang on to that stuff for any longer than it takes you to reconcile it with the other records. So if you take money out of the ATM and you get a receipt, you don't really need to hang on to that for any longer than it takes you to match it up with your bank statement at the end of the month to see if that ATM deposit or withdrawal was recorded correctly. Same thing with credit card bills and things like that. Unless you're using the credit card statement as a record of your transactions, as long as you verify that the charges are correct and paid the bill, you don't really need to hang on to the credit card statement. Some other things that you might keep up to 1 year, property and casualty insurance policies that get renewed annually, like auto insurance, homeowners insurance. You're going to get a new policy every year. When you get the new policy, throw the old one out. It's been replaced and it's no longer really of any value to you. And also, you can get rid of investment statements. Many custodians for investments will send year-end statements, and I often encourage my clients to just hang on to the year-end statements. You can actually pitch the monthly statements. One exception to that is if you don't get any other record of transactions you make, particularly purchases and sales of securities, and the only record you get is on the investment statement, I would hang on to any investment statement you have that reflects a purchase, particularly a purchase and even a sale of an asset. But just here's what my account is worth, you don't really have to hang on to those much longer than a year. Next category, things that you keep for potentially as much as 7 years. All right, so some of those things, number one would be tax returns. There are a lot of different statutes of limitations that the IRS has on investigating your taxes, but generally the longest one is a 7-year period if you've neglected to report more than 25% of your income. Now, keep in mind, if you've just completely failed to file a tax return, the IRS can go after you for as long as possible. But if you filed a tax return, if you hang on to it for 7 years, you're probably in good shape. But I often encourage people to hang on to their tax returns forever, and that includes the things that go along with it, like the W-2s and 1099s that you use to prepare the return. And then the final category are some things that I would suggest you keep indefinitely. So it may be for a certain period of time, or it may be forever, just depending on what the document is. Records of purchases of assets, investments, and things like that. Titles and deeds to property, cars, you'd hang on to those as long as you have the property. Loan documents you'd hang on to until the loan is paid off. And wills and trusts you'd hang on to indefinitely or until the will or trust was restated if you ever revise your estate plan. So there's some guidance on some of the paperwork. There's a lot more to it than that, but hopefully that gets you started in the right direction. All right, up next we're going to answer a viewer question on buying stock in the company you work for. Stay with us, there's more to come. To the Money Pros. I know I promised you the answer to a viewer question on employee stock purchases, but we're going to have to save that for another show. Having said that, if you've got a question for the Money Pros, you can contact us on Facebook or via email. We always like to get your questions. That's it for today's show, folks. Thanks for watching. We'll see you again next Sunday right here on the Money Pros. Have a great weekend.